Good morning, Cindy. Good morning, Cindy. How are you? Good morning. My name's Dave Fairchild, and I'm part of our investment committee here at EverBless Foundation. And on behalf of our investment committee, I want to welcome you. Thank you for being here, and thank you for allowing us to invest some of your assets. Obviously, before I do that, I should say we also have a couple other people from our investment committee here. I know Britt Glisson is here, and Gray Key, who's got Leah Hopper is going to be here, I guess. Okay. So I don't need to tell this audience that 2022 was difficult for us as investors, right? Actually, oil was up 10.5%, and gold was up 0.3% after languishing for I don't know how many years. But it was definitely difficult. In fact, every other category was down. NASDAQ was down 32.5%. And I looked at it. There were seven companies, and they're the big ones. Apple, Microsoft, Google, Alphabet, NVIDIA, Tesla, and Meta. Those are the seven. In 2022, they lost $5 trillion of market cap, those seven again. So it was obviously a tough year, right? In fact, there were lots of swings in the headlines. We had all those headlines of, obviously we had worst inflation in 40 years. Companies quickly pivoted from investing in growth to cutting costs. We had headlines like, 2023 is going to be the worst recession we've seen in a long time. And then you could read another one that said a soft landing is on its way. I was reading an article at the end of 2022 that said, well, the 60-40 portfolio allocation is finally dead after so many years of kind of being the standard. It's dead. I saw an article just the other day that said the 60-40 portfolio has had the best start of the year in over a decade. So, we've been whipsawed by all that. But I hope you are long-term investors. We are. And I know when we have our investment committee meetings quarterly, we rarely talk about the headlines of the quarters. In fact, when our discussions with Vanguard, mostly the discussions are about diversification and rebalancing long-term investing. So again, on behalf of the EverBless Foundation, I want to thank you for entrusting us with your investments. It's a fiduciary responsibility that we take very seriously. And so let me turn it over to our president and CEO, Todd Fuller, so he can introduce our guests. Thank you.
Welcome, everyone. Excuse me. Thank you for being here. Back since 2019, I guess. We're back in this room. And so it's nice to have everyone back and see familiar faces, and we thank you for coming. Just want to recognize a few people before we get started, and we'll pass it on to our folks from Vanguard. But I want to recognize all of our board members. If you would stand so that everyone can identify you. And Jolynn, that includes you. Jolynn rotated off in 2022, but be sure you speak to these folks as you leave. As Dave said, they're very important and very important part of what we do, and we sure appreciate their help. And John Hatfield, you didn't stand either, and you didn't just rotate off, but you're a former trustee. So, but thank you all, thank everyone for coming. 2022, as Dave said, difficult year. But like he said, we don't really talk about the headlines. We don't focus on that. We think about the long-term picture, and we want you to stay focused on that. Looking at our board for 2022, and as we mentioned, Jolynn is on, and John Beck are two that have rotated off. And don't see our two new board members. I think they're en route. I know one is en route, but maybe we'll be able to recognize them a little bit later. But a special thanks to this group. So what about EverBless? We ended 12/31 with $194 million under management. Right now we're at about $205 million under management. Looked at this last night in preparation, looking over the list of everyone that's here. Everyone in this room and the responsibilities that you have for the different dollars that you have with us, there's right at $70 million represented in this room. So it's a significant amount of these dollars is in this room. And so we're thankful for your due diligence and being here and keeping an eye on things. 900 plus accounts here. We opened 36 new accounts this past year, which is a little bit above average year for us. So it was a good year in that regard. What are your peers doing? So you all know the portfolios. Equity being our most aggressive, most volatile, best potential return. Fixed income, least volatile, but the least long-term return, and then the balance, the combination of the two. But what are your peers doing? This is the groups here. As you can see, 55% of the group of the accounts, and there are over 500 accounts involved in these portfolios, and over 50% of them are 100% in the balanced portfolio. I'll leave it to Jerry and Becky to talk about the specifics there and comment on the 60/40 and whether it's dead or not. We'll look forward to hearing about that. But again, just know that this is what your peers are doing. Think about your asset allocation. We're happy to help you reallocate in any manner that you need, and that's easily done with a request from you. So. And our Vanguard team. Becky and Jerry are here. Carol was not able to make it today, but Jerry leads the Atlantic and South nonprofit team for Vanguard. Jerry started out with us in 2009. So when Jerry spoke in 2009, our organization as a whole was about $70 million. And so that much is in this room here today. So we've grown quite a bit. But Jerry's been with us since 2009. We moved fixed income to Vanguard in 2009, then moved all of our equity over in 2013. And he has brought Becky with him to answer all the difficult questions today, correct? Yes. And as I imagine. But I'll turn it over to them. They're gonna lead us through the book, and then Dave and I and Becky and Jerry will all be up here for some question time afterwards. So enjoy. Thanks for coming again.
Morning, everybody. Thanks for having us here. Vanguard wants me to change that picture. I'm holding on to it as long as I can with the dark hair. They keep asking me. I was saying to Dave and Todd, 2009 was the first time I was ever here to meet with Virginia Baptist Foundation at that time. So long ago, 2009, our youngest of three was 4 years old. And last night I had dinner with her at college. She's about an hour away. She's going to school. So a lot changed in the time that I've been working with you all. And it's been a great experience for me. I've said this to this group in the past. We've got a couple thousand clients in the nonprofit area at Vanguard. EverBless, favorite client. So if you all ever need anything from me, I'll be here. You stuck with me when I was a lowly salesperson at the beginning. Fortunate enough now to run the East Coast for our nonprofit business. So I'm delighted to be here. Carol had another board meeting today. So again, truthfully, Becky Farnsworth is here to answer all the difficult questions. I will say that the 60/40 is not dead. It was a tough year last year in fixed income, but because it was a tough year, rates are high, yields are high right now. Vanguard is projecting return in fixed income over the next 10 years of about 4 or 5%. And we certainly haven't been able to say that to our investors over the last couple of years. So that being 40% of a 60-40 portfolio, we think that augurs well. Little overview of Vanguard. Some of you all have heard this before, but for those of you who haven't, just an update about who our firm is. Our core purpose: take a stand for investors, treat them fairly, and give them the best chance for investment success. Jack Bogle founded Vanguard. He founded on an idea he had in graduate school, which was, could one set up an investment management company that was owned by its investors? So Vanguard is a truly mutually held investment management company. You all own the Vanguard mutual funds. The Vanguard mutual funds collectively own the Vanguard management company, and we operate at cost for the benefit of our shareholders. So when you all think about Vanguard, think about low costs. We do a lot of indexing. It doesn't cost very much to index, so that's true. But really the reason that our costs are low and our client returns are higher is because there's not a profit incentive for Vanguard. So there's a profit margin in investment management of between 25 and 40%. So that's off the table for Vanguard's return into your portfolios. The other thing we hope it does is on our decision making. When we have a question, when we have a decision to make at Vanguard, we ask ourselves, is it in the best interest of our shareholders? If it is, we do it. If it doesn't, if it's not in your best interest, we don't do it. So we think we're aligned that way. And we like to hope and think that we're not in the headlines too much for negative type stuff you see from some other financial institutions. So hopefully you feel good about having your money at Vanguard. About our business, it says $55 billion now, but on an advisory basis, we provide advisory services to mostly nonprofits and also pensions. About 3/4 of our business is with nonprofits. Right now, we're close to $60 billion in assets, and there's 130 of us doing that work. Very highly credentialed group at Vanguard. Out of these 130 people in our institutional advisory services business, 52 of them have MBAs, 52 of them have CFAs. Their CFPs and other higher education. So very well credentialed, very deep with their investment management, investment knowledge, managing assets on behalf of our clients. 85 religious organizations are faith-based, and 46 in the state of Virginia. We like it when our clients say good things about us. There's a company called Cogent that does survey interviews of institutional investors. They asked, the last time they did this was in December of 2021, they asked about 800 nonprofits and pension plans, out of the investment managers that you work with, or these names they show you, what's your favorability ranking of them? And Vanguard happens to rank the highest for nonprofits and pensions. So very proud about that. So we're in this business. We'd love to help our clients' portfolios grow. You all from $70 million to about $200 million now. This is where I want to spend most of my time before I make Becky talk about 2022 in more detail. A lot of words on this page, but this is a snapshot of how Vanguard has worked with EverBless, with the staff and the investment committee on your behalf over the years. So the easiest way to think about this is our goal is to try to support the investment decision making for EverBless every step of the way. And it starts on the right-hand side with investment policy consulting. So as you probably know, there's an investment policy statement that governs how we're going to invest the assets, all the different asset pools for EverBless, whether that's the equity pool, fixed income balance, the donor advised funds, any of the other pools of assets. It's our touchstone and guiding document, so we always go back to there. When there's cash flows coming into the portfolio or leaving the portfolio, we go back to the investment policy statement to make sure we're investing them the way we've agreed to. And we agree upon that with the investment committee. Asset allocation analysis, very important. Carol, who you saw on the first page, and some of you know, she runs an asset allocation analysis for her clients every year in the first quarter of the year. So she'll be running one right now for EverBless, just to make sure, is 60-40 the right allocation for balanced? How should we be thinking about the longer term portfolios? What's Vanguard's outlook in terms of returns and volatility for the asset classes? She'll be bringing that to the investment committee. We'll talk together to decide if there's any changes that need to be made in the portfolios. I will say the investment committee has been highly engaged with Vanguard throughout this process over the years. Very good working relationship, but they push us and challenge us, and so we try to get to the right place for the portfolios. Portfolio construction, like Todd said, we started out in fixed income. We added indexed equities at one point. Then over the years, active equities into the portfolio. private investments is something we've been doing more recently. So the portfolio construction phase is iterative and it's changing all the time. Portfolio monitoring and client service, I'm going to put those two together before I step aside for Becky. This is something else I want the group to know. So we're looking at the portfolios all the time, real time. We see everything every day, making sure the portfolios are all in balance. Cash flows are getting handled the right way. Todd, Wendy, and the staff, they're completely squared away with the way the cash flows are going. So it's a true pleasure to work with that. On the due diligence side, we go to see our clients often as we can. It was harder during COVID time. We also invite our clients to come see us at Vanguard. It's the best way to get to know what's going on at Vanguard, meet senior management, meet portfolio managers, risk managers, our economists. Again, we have 1,000 clients. I've worked directly with hundreds of clients over the years. Always invite them to campus. Probably 20 clients have come to campus to see us, and it's great. It's the best day of the year because we get to showcase what we're doing at Vanguard for our clients. 2 clients come to campus regularly, annually in non-COVID years. One of them is 10 minutes away from us in Philadelphia, right? The other one is EverBless. They come up to campus with their staff, their investment committee, some board members, and spend a day and a half with us just to make sure that they understand, who is managing the assets on their behalf, make sure the Vanguard senior management understands who EverBless is. So we love that. Hopefully get that going, now that COVID is behind us. But I just want you all to know, again, from a due diligence perspective, nobody's doing more diligence on us as advisors than EverBless committee and the board is. And we're very happy to have that. Before I make Becky talk about the terrible markets in 2022, and then she's going to talk a little bit about the economic environment right now, and more importantly, the look ahead. Are there any questions I can answer about Vanguard? Yes. We're in Malvern, Pennsylvania, which is about 30 minutes west of the city of Philadelphia. We will pick you up, and we have picked them up, but then they started taking a big bus up there. I don't know how comfortable that was for everybody, Dave, but yeah, if you're on the train, we'll pick you up for sure. Any other questions? Okay, great. Becky, here you go.
Start with that.
Yeah, I'm sorry.
Thank you so much for having me. Kara was very disappointed that she wasn't able to make it, but I'm thrilled to be here with all of you to talk about the year of 2022. And to Jerry's point, I think we can cover what happened. It was really terrible. We all know that. But look at the economic aspects, how that made the market perform, but more importantly, again, looking ahead. I will tie in some more recent data points. I don't know about all of you, but 2022 feels like it was 100 years ago. And we've gotten a lot of new economic release. Tuesday, CPI came out, new inflation data. So I'll try and weave some of that in, but I think Dave said it really well. I'm going to talk about a really finite period of time and some extreme things that have happened, but I really don't want to neglect to just reinforce that point that we are, and all of you, personally and professional dollars for the long term, you need to think with a long-term strategic focus. So I'm going to give you some, I said that would buzz if I put it too close, I'm sorry. So I'm going to give you some groundwork for, where we are, but most importantly, what that means for where we expect things to go in the future. So this first page breaks down calendar year performance for equities, fixed income, and then the 60-40 blended portfolio there. This is 94 years of history. So the x-axis is the returns, and the y-axis is the frequency of which those returns happen stacked on top of each other. So you see the equities, declining 19%. This is focused on the US, but really the same story could be said for international. There wasn't any great markets anywhere, so it's a good proxy. Bond performance, all the way to the left. Never have we seen bonds have such a poorly returning year. And what that means for a balanced portfolio of 60% stocks and 40% bonds is that it was down almost 17%. This next page, it's okay, all right. This next page, it gives a little bit more numbers and data around how really bad this was. but maybe a little bit of hope that this is not something that happens frequently. So this top part shows the percent of time that both stocks and bonds perform negatively. You see, over really short time periods, that can happen very infrequently and never over 3 and 5 years. Now the bottom is the 60-40 portfolio returning negative. You can see again, over those longer annualized time periods, how infrequent it is to see negative returns in there. So it gives a bit of context around how really obscure this market environment was for stocks and bonds, but the likelihood that this is not frequently and is not likely to persist going forward. So, what are the big drivers of these returns? I think it has to be, inflation. We hear about it constantly, and okay, maybe I'll put it in my pocket. Headline inflation, is at a 4-decade high. It peaked in September at about 9%. Tuesday's inflation report came in at 6.4%. So it's coming down. I think these numbers are positive in that regard. We'll have some green shoots to talk about here. This bottom chart, same, shows monthly headline inflation in the blue, and then that's core inflation in the yellow. That takes out those really volatile food and energy components of the consumer price index. So it's a little bit more muted. Started out 2022 at 5.7, ended 2022 at 5.7, and just came in for January at 5.6. So those numbers are coming down, but I will note they were above expectations. So, the market forecast, what it thinks these prints are going to come in at, it was about 20 basis points lower than what it came in at. So improvement, but maybe not as much as we're hoping and potentially thinking optimistically that it would come down. The top right chart shows unemployment. To make all of this so much more challenging is that we have an incredibly tight labor market. Unemployment currently sits at 3.4%. That's lower than it was before COVID. Wages, and in particular in those kind of labor-intensive services, have been softening, but the labor market the jobs continue to surprise to the upside. I don't know. Can I? I'm sorry for everybody.
I don't think it's you. When we tested this yesterday, I think it's just old wiring.
Okay.
And
all
there's,
right.
But I'm sorry about that.
Oh no. All right. As long as it's not me, I'll change my method. I'll stand over here. So again, and unemployment came in below. They thought it was going to be at 3.6%. It came in at 3.4%. So we're seeing improving numbers, but still a little bit more. There's a ways to go. Let's say that. The components of CPI down at the bottom. Most recently they kind of rejiggered the components. Energy was the biggest contributor thus far, but it kind of shows some of those main drivers. Shelter being one. No is a very lagging indicator. And the Fed has acknowledged that is not as current as some of the other components of CPI and are taking that into account. And speaking of the Fed, so what do we do about inflation? How do we get it to come down? Well, the Fed takes this very blunt tool of monetary policy and whacks the economy with it. We've seen 8 interest rate increases since the Fed started raising rates in the beginning of March 2022 consecutively. So we went from a 0 policy rate, and we currently stand at 4.5%. Our expectation, which is also kind of consistent with the market and other forecasters, is that there will be 2 more 25 basis point increases to 5%, and the Fed will hold there for the duration of the year. That's our expectation given current information. Not expecting any rate cuts in 2023. So, we haven't seen inflation this high in 40 years. Theoretically, the Federal Reserve will raise interest rates. That will squash demand, and that will bring down inflation. So we've kind of seen some hopeful signs of that on the previous page, that is working. But certainly monetary policy, as I said, is a blunt tool, and it takes some time to work its way through the system. So the idea is that we will continue to see those inflation numbers come down as the Fed lets that monetary policy kind of take hold. The yield curve. We hear a lot about the yield curve. You know, the rising of the Federal Reserve rate is the cost that banks lend to each other overnight. So, you know, the cost of borrowing money is all tied to that overnight rate. This would be the shorter end of the curve, you know, those shorter duration bonds. The longer end of the curve is down, you know, 10, 30 years. That's when you talk about the short and long end of the yield curve. The short end is really fixed to that federal funds rate. So as that pushes up, kind of those nearer term rates go up with it. The longer end of the curve is more impacted, you know, certainly by the where it starts, where the short end is, but also kind of on economic expectations. You know, where do we think the economy is going to be down the road? And with that kind of heightened concern over recession, you know, that's really weighing on that longer end. And the Fed continues to push up the short end, so that's kind of what's generating that inverted yield curve that we hear a lot about. Now, it's preceded every recession. Also, the one in 2020 that I wouldn't say had anything to do with the yield curve inverting. If we're looking at this today, you know, it looks about the same. You know, about 5%. The long end looks about the same. So, you know, there hasn't been much change in the yield curve over the course of 2023 thus far. So, you know, this is the fun stuff. We can look at how terribly the market returned because of this environment that we're in. So this is looking at equity, fixed income, and then balanced portfolios. So it's 3 months, year to date, and 1 year. So these numbers are the same for the year to date and 1 year. A little redundant, sorry. But looking mainly at the 1 year time period, you know, it was terrible across the board. You know, I think that's what's really so, you know, resounding about this chart. You know, save for some currency movements that we'll talk about, you know, in the most recent quarter, you know, there really was nowhere to hide. And I think what is, you know, most striking about this is typically you think about your fixed income as being that ballast during times of equity market weakness. It is that stabilizing force of your portfolio. It really didn't have that type of impact that it typically does. So you see a portfolio of 60% stocks, 40% bonds was down a little over 16%. The 70-30 portfolio was down just 50 basis points more than that. You would expect a 10% allocation to fixed income to give more stability than that. I think that's really striking about how difficult this market environment was. All right, this is digging into U.S. equity. So the first 3 bars show by capitalization, and then by style, and then we look at non-U.S. equities over there. You know, capitalization, the size of the company, didn't matter. You know, we've seen mega cap companies, mega cap tech particularly, do so extraordinarily well. They sold off just as much as small and mid capitalization companies over the full year time period. I think the biggest kind of divergence that we can talk about is the difference between growth and value. That really highlights kind of the impact that interest rates have on equities, I think most resoundingly. So value companies have much more stable, present cash flows. Typically they pay a dividend. Their balance sheets are much more known and available information. They're paying you confidence in what the earnings of that company are more than you do in growth companies, where you're looking out until much further in the future to estimate what those cash flows might be, and then you discount them back to today's value to determine what you want to pay for that company. If you discount them back at 0, you know, you're getting a lot more earnings today. But when you start raising that rate that you're discounting back, the company loses a lot of value in its present day terms. So that is one of, you know, there's lots of impacts that interest rates have on growth companies. They tend to be more highly leveraged, so their cost of borrowing goes up. But you see that really come to pass in the disparity between value and growth stocks. And then currency was also a big factor over the course of the year. The US dollar, the world's reserve currency, tends to perform very well during times of volatility, uncertainty. So the majority of 2022, the US dollar did exceptionally well. It was up 17% through September. We did see a reversal of that. The fourth quarter was a positive returning quarter. We saw a little bit more confidence, and that came through a lot in the currency. We saw the US dollar come down. So if you look at international markets, there's developed and emerging markets on the end. The developed specifically, if you think of the one-year time period in local currency terms, so what these international companies produced in their own currency, they were only down 7%. You translate that into US dollars, and they were down 16% or 15.5%. So that was a lot of what was driving that really strong performance in the fourth quarter, is that reversal of the currency. They then got the boost of the currency, and we saw some outperformance of the non-US companies in the fourth quarter. And sector breakdown. Energy is the big standout, certainly. Demand-driven, need-driven because of the sanctions on Russian oil because of the war in Ukraine. Energy performing extremely well. You see all the way over to the right, kind of the worst performing sectors are those that are more growthy in nature, are more tech-heavy, are more cyclical. So the information technologies, consumer discretionary, communication services, they hold a lot of those big companies that Dave was talking about. Those performed the worst over the course of the year. I'll just note that year to date, those three sectors to the far right are up between 13 and 14%, and energy is in about the middle of the pack, up 2%, just to give some context around more recent performance. And then the fixed income. Again, really nowhere to hide there. Across each various asset class of fixed income, returns were nearly equally dismal. The difference there would be the longer term bonds. Those are your largest ballast during times of equity market weakness. Those are your insurance policy of your portfolios, theoretically, and do have a place there. But they have the most interest rate sensitivity, which really drove a lot of that, really drove performance specifically with the longer term bonds. Inflation protected securities are priced against current present day inflation. So they did fairly well in relative terms because we experienced some very significant real present inflation over the course of the year. But even in that sense, all performance kind of negative for the year across the fixed income environment. So what does all this mean for going forward? And how should you think about, the construction of your portfolio for the long term? That's a very important part. Let's give some numbers and context around that. So here's a lot of numbers on this page, but really to summarize, these are our expectations for growth, unemployment, inflation, interest rates going forward. Now, this is Vanguard's estimate, and then it shows kind of broad market consensus. All of the various investment firms put together these types of estimates and show ours in relation to them. First thing I would note is that our expectations are for the US, the Eurozone, major developed economies to have flat or slightly positive growth for the year 2023. The outlier there would be the UK specifically. The IMF is predicting the UK to be the worst performing G7 country in 2023. They have the post-Brexit environment makes managing through this time period where they structured themselves to cut off European labor. Now is a period where that would probably benefit them from a wage price pressure situation. Companies have a harder time trading with Europe. Lots of things behind the UK. I will also note China had some really strong economic data coming out. There is the removal of the COVID restrictions. We've actually increased that expectation for China. That is good because that will help to buoy the global economy. and strength in China can potentially help to alleviate lessen the chances of a major global recession occurring. Let's see. I think the inflation forecast, our expectation is that the Fed will be successful in bringing inflation down, but we are not going to get to the 2% target that they have by the end of the year. Our expectations around 3%. You can see that that's higher than the general consensus that we're going to get to below 2.5%. We think it's going to be a little bit higher than that. That kind of plays into that idea that monetary policy is going to remain elevated at the level of 5% for the duration of the year. There's two slides here. One is focused on equities and one is focused on fixed income. That I think, I'm going to maybe have you focus on the 50th percentile line, and then the 25th and 75th bands around that. These are Vanguard's capital market expectations. We do this for 30 asset and sub-asset classes. It really helps to inform a lot of those asset allocation studies and information that Jerry was talking about. This is a look to the future. This is what we expect capital markets to return over the next 10 years on an annualized basis. And if you looked at these last year at this time, you'll see that across the board, they're about 2.5% higher than they were then. So if we're going to look for the silver lining on all of the really negative numbers that I just talked about, I think it is the effect that it has on future returns. Simply, valuations are considerably lower, and that discount rate is considerably higher. So our expectations for what markets are going to return are very elevated from where they were a year ago at this time when valuations were extremely high and we had 0% interest rates. Same thing with fixed income. Again, the 50th percentile. Fixed income returns are going to be really closely tied to your yield. That is by far the largest driver of total return in bonds is going to be the yield on your fixed income. So you see they're very close to what yield expectations are. I thought it was really interesting that high yield corporate bonds, the riskiest area of the fixed income market, was down to yielding 3.9%, below 4% for high yield fixed income. Right now, that's what cash is giving. So you see how the dynamics of this really uncomfortable rise in interest rates has changed the forecast and what you can expect from your fixed income portfolio. With a return expectation, there is now return coming from your fixed income side. I'll say all of that about our capital market forecast to show you this. In the near term, forecasters, Vanguard included, this is all of the investment firms that make these types of forecasts that Bloomberg tracks. They aggregate them all together. And from top to, median return is that little dash in the middle. And over 1 year time periods, terrible at forecasting what returns are actually going to be. 75% of the time, they don't even fall within the 25 to 75% band. So, over a short period of time, these aren't great indicators of how this isn't what you're going to see when Carol comes and talks about 2023. But over longer periods of time, and this is focusing on Vanguard's returns, or capital market expectations. This solid line shows the 10-year rolling returns. So the 10-year rolling return right now is at 5.5%. And then we go back and take what Vanguard estimated the 10-year forward return would be and overlay that. So you see, that's kind of why I anchor between that 25 and 75%. The vast majority of the time, the actual expectations fall within that band of 75 to 25. And then we extended it out so we can see kind of what the current market environment has done to change our forward outlook. You see how at the end, thinking out another 10 years in the future is markedly improved our forward outlook for what capital markets are likely to do on a 10-year rolling basis going forward. So it's a lot of data and a lot of hopefully erring in the side of, we're going to use the baseball analogy, which I think works pretty well here. We are likely closer to the 8th or 9th inning than we are to the start of the game with respect to interest rate increases and the impact that that's going to have on the economy. Now, there's a lot of uncertainty out there, certainly, but we feel that capital markets going forward are in a better place from a return perspective based on what we unfortunately had to endure throughout the course of 2022.
The 5.5%, that's based on the 60/40%.
Yeah, exactly. So balance between, this is, the solid line is based on a 60/40 portfolio, globally diversified, international and US. So that is the 10-year rolling return for a 60/40 portfolio.
This question is sort of global in nature. You talk a lot about the different balance between 60/40, 70/30, whatever. As you look at your entire empire, so to speak, of all these funds, all these different nonprofits, what would be the prevailing number? How many are 60/40, how many is 70/30, how many 80/20? Now, I'm not sure how important that question is, but as I keep thinking through what we're doing at Hope Tree,
Right.
I wrestle with this balancing candidate quite a bit. So I don't know, it's just a global feel-good question, I guess.
Right. It's a good question, and I wouldn't say, the right asset allocation is one that you can live with during the 2022. Your organizations went through an incredibly challenging period with COVID, and then the market's doing what I just talked about. So my thought about the appropriate asset allocation is if you can endure and sleep at night and maintain through those really challenging periods, I think you've achieved your right asset allocation. I think about your time horizon and your there's two parts of risk. There's your tolerance and your capacity. Your capacity is based on how much you need that money. If you really need that money, you want to be a little bit less risky. But if you have the tolerance is what enables you to maintain that long-term view, and that's really what's going to drive your growth over the long term. So if you're able to maintain with a higher allocation to equities, generally over a longer period of time, that is going to contribute to higher returns. Go ahead.
So you brought up the pandemic. And I didn't want to interrupt your flow. So back on page 11, where you talk about going back to 1928.
Yep.
Did you study, okay, I'm an accountant, so, market, history, So we're looking at right before the second big market crash in the U.S. and then followed by World War II, and so there's a lot in that history.
Yeah.
But I think back to 1918, the Spanish flu, which is the last time the U.S. has endured a multi-year pandemic. Did y'all not have a history, or did you feel like the market was so fundamentally different it wasn't worth trying to pull those two out to see
Right.
if, in fact, what we're seeing now is really no different than what the market did after the Spanish flu?
That's go ahead, Jerry.
I think the answer to that question is we don't have a history, but we'll find out and let you know, because the benchmark providers only go back so far on, I want to say it's the fixed income side. We'll find the answer. Because our economists they geek out on it too, and they try to go back as far as they can.
Right, but comparing, I don't know whether they decided that just before the market crash, it sort of, it's sort of similar to what happened. But you think about what was happening, the Industrial Revolution was just taking off. Speculation is much more volatile than it is now, believe it or not. It's held within a much smaller group. It's not really open to the average investor. So I was just kind of curious.
Yeah, and it's unregulated,
Right.
essentially.
See, it was a wild.
We'll ask the economists what it was,
Okay.
why they stopped.
Because I'm just curious, because that can actually be quite comforting to a lot of people to realize, if you go back 100 years ago, these two pandemics look very different, or very the same economically, can help us inform sort of what we've just been through. And, I don't know, it just struck me as 1928, not 1918.
No, yeah,
So thank you for letting me.
My question is a little more direct than Dick's question. Based on your forecast, 35-year forecast, how risky is a 80-20 mix?
from a volatility perspective, or theoretically, let me go back to the, it's this last column that you're going to see, where you look at market volatility. How much are those moves in your equities versus your fixed income? So equities, you see, high teens, low 20s. When you look at the volatility theoretically in your fixed income, is considerably lower. That's really what it is there to be, is your base, your level of stability. You're looking to your equity component to be the growth engine, but it's also going to be generally your biggest driver of your volatility of returns. So I think that's really the part that drives the ability to, when you see your portfolio, in a typical year, not where everything is going down 15%, but that drop of 20% in your equity portfolio, and with the ballast of fixed income, is that the comforting level? If you're thinking out, your time horizon is 10, 15, 20, perpetual, you have a lot more ability to live through the volatility that equity markets are going to bring. So that's kind of how I gauge my conversations with clients about what is the right portfolio mix. I will always say that it is the one that you can sleep with at night, but the one that is able to give you you think about your time horizon and then what your objectives are, and then match your allocation to that in a way that you can be comfortable with the volatility that's inevitably going to come more from equities than fixed income.
Becky, if I could just
Oh, yeah.
jump in. No,
Do
thank
you want me to stop?
No, I don't want you to stop. I love it. It's Todd's call. Todd actually asked us to run that. I don't know if Becky knows this. So we did run an asset allocation. So the volatility over the next 10 years for an 80-20 portfolio is about 14%. This is standard deviation. The max drawdown, worst case scenario that we ran was 32% for an 80-20 portfolio. So not for the faint of heart, but again, if someone had an 80-20 portfolio and made it through 2022 and didn't really have to change your business operations or personal consumption too much and could withstand it, then we'd argue for an 80-20 going forward. But those are actually the numbers, so we can talk about it later too.
Keep going.
I have another question about how does Vanguard utilize alternatives, real estate, private equities, private
Right.
debt?
Those are asset classes that have the ability to generate higher returns than private markets. They're a very big part of the capital market landscape, but they do come with illiquidity risk. Theoretically, you're getting a premium for taking your money and locking it up. I think that, thinking more about the private markets, there's a lot of alternatives. There's lots of commodities, and we can look at different aspects. I think they all have their own component. But private markets can be, if you have the ability to tolerate a portion of your portfolio that really you shouldn't be touching for 10 to 15 years, if you have the ability to tolerate that type of liquidity, I think that it has a place in portfolios to help generate higher returns.
And how much would you utilize that in an institutional portfolio?
It's all dependent on how much illiquidity they can handle. We talked to EverBless about it for several years before we went down the road of private investments. If it's a perpetual organization, no real liquidity concerns, we're starting in maybe 20% of the portfolio to 30% in illiquids. That would be private equity and private real estate. A lot of our clients say, it seems like a little bit. They say, how long's the lockup, Becky? And she says 10 to 14 years. And they say, well, 30% doesn't sound great then. Maybe something closer to 10 or 15. But we start our modeling around that 20 to 30% range.
We don't currently offer that for assets that are managed for churches on a replicable basis. Our perpetual dollars that we're holding, we do have some exposure there in private equity. We just started 18 months ago, 18 months ago, 24 months ago with that. You know, we've had private equity for years. Private equity, sorry, REITs for years.
Yeah.
But private equity is something we've just started fairly recently.
Do you take that out of a different, like 60/40? Do you take that completely out of that asset allocation?
We take it out of the risk. We take it out of the risk assets, the 60%. So it's part of the 60% when we do it.
Okay.
Sorry.
Yes, Becky, I have a question. Our church has this endowment with EverBless, and this is a meeting here, but for the average person sitting on the pews on Sunday or watching us on Zoom or Facebook Live, what can we tell them about what 2023 is likely to be like?
Gosh, if I knew the answer to that question. Yeah, I think the growth expectations are maybe a good way to put that. But last year we saw 3% GDP growth, so and markets performed the way they did. So that I don't know that they're necessarily correlated. There's a lot that can still flow through. With I mentioned kind of the monetary policy aspect it takes a while to come through. There is the soft landing, the hard landing, and everywhere in between is all a potential option. But I think we could, looking at these numbers, from what trend is to what we are expecting, I think that can give you a good framework for kind of maybe an improvement economically, but we all know that the economy and the market are two totally different things. So maybe a market improvement in the economy and how the market reacts to that.
So we should see some improvement over 2022 then.
I would hope so. That's what we're all hoping. Jerry, do you have anything else to add to that?
I would just say it'd be hard to imagine anything could happen, but the 2022 is so historically bad, and interest rates are so high right now that it's very unlikely we have another 2022. One thing they can probably count on is they're finally getting more money from their savings accounts, their bond funds, and the like. Again, that was we were 1 or 2% this time last year, and now it's 4 to 5%. So that's money in the bank kind of.
Any more questions?
Yeah, I don't know which page you're on. I was just slightly curious, your types of equities with, they include real estate investment trust, yes, that one.
Yep.
So the global ex-US equities, so that's where you're talking about companies that are incorporated in the US, but all their business is done outside.
Those are companies domiciled in global non-US countries.
Got it. And the real estate investment trust, I was surprised to say that sector is still large enough to be considered in this group.
I think we all think of REITs at like shopping malls and office buildings, but there really has been a very decided change in what's the structure of the REIT market looks like. That is now much more industrial, manufacturing, storage, cell phone towers. So, I was thinking about that kind of return in that context.
That actually goes back to my question about comparing the Spanish influenza to COVID, because I see REITs is going to be very volatile over the next couple of years as companies realize I really don't need a big corporate office anymore, because our workers can be productive at home because they've had to for the last 2 years. And so I see a lot of volatility.
Right. It certainly puts a lot of pressure on that.
So I was surprised to see it.
And we agree.
Okay.
Yeah, so on the far side, that's the second most volatile asset class for us. So yeah, we'll be
Yeah, so
there.
I was surprised to still see it here because that's where I see the trend with REITs going is that a lot of them are going to collapse. But thank you.
Any more questions? Well, thanks. Thank you, Jerry, for bringing her along. Yeah. Answering the tough questions. Just a couple of more things before we dismiss. Just want to recognize and make sure everybody knows this. The EverBless team. Cindy Elmore here on the front row. Stand up, Cindy, so they can see you.
Oh, I think they've seen me.
Back on the back row there, Wendy Reynolds. Everybody knows Wendy. Cindy Strain beside her. Cindy is newest to our team. She just started last September. She's an director of accounting. And Janet Best, peeking through the door there. For those of you who don't know, Janet, Wendy, and Cindy in the back, are here in Richmond with me. We're in Richmond. Cindy Elmore, and then we have two others, Alicia Corbett and MJ Fanning. They all work out of Roanoke. So Alicia's on vacation this week, and MJ did not make the trip. So, but we thank you for coming. We appreciate you. Just want to give you a little uplift here before we dismiss. There's some EverBless swag on the table up here. You're welcome to help yourself. Our latest issue of our magazine and a packet of information about our Bible study video, Unstoppable. I really encourage you to take one of those and look at that. But a little bit of, if I can take a moment and show you, we have a little video here, a little 1 minute video on this video before we start. So we're celebrating our 100th anniversary for those of you who don't know this year. So we are doing so as part of our celebrating. We are having 9 luncheons across the state. We've already had 2. We had one here in town. We have one in Lynchburg. We have Danville coming up, and then at the Marine Museum up in Northern Virginia. Those 2 are next on the list, and then we visit the beach area and Southwest Virginia in the fall. So if you haven't been invited, you are invited, and we'd certainly love to have you attend one of those, and just let any of us know that you'd like to be a part of that, and we welcome you to celebrate. Another part of our celebration is that we awarded grants we contacted our scholarship recipients from prior years and gave them the possibility to submit an application for $1,000 to do something with that $1,000, to do something good. And we selected 10 of those, and this is just a little 1 minute video on that.
Hi, my name is Emily Breeding. I am a junior at Bluefield University. I am also a member of the Honors Program. And back at home, I am a member of North Star Baptist Church in Bristol, Virginia. In receiving the Centennial Celebration Grant, I was able to participate in 2 summer camps as a camp counselor and minister to local inner-city students. Through these camps, kids of all ages could attend to have an opportunity to be a kid for a week without worrying about where the next meal may come from or where they may be sleeping. This experience has taught me more than I ever thought it would. In attending camp, I was able to work with kids from different backgrounds and interact with them. I was able to share Christ's love by just being the person these kids could talk to at camp. I am very appreciative of the opportunity of receiving this grant. Thank you.
So that's just a part of the celebration and our foundation helping you move your mission forward. And so we want to continue to do that. Feel free to mingle as long as you like. Jerry and Becky will be here for some more conversation and questions if you want to talk to any of them directly. And I see from the table over there are a lot of chicken nuggets left. And feel free to hit that again. So if we could all stand, and Rob, if you would dismiss us with prayer, we'll dismiss.
Gracious God, our Father, we thank you for this gathering. We thank you, Father, for EverBless, and we thank you with our partners with Vanguard. Now we pray that you will bless and keep us from this time and forward. It is in the name of Jesus we pray and we give thanks. And everybody said, Amen.
Thank you.
How are you doing?
Sir?